Good morning, everyone. Afternoon for some, evening for others all over the world. Welcome to today's 98% Club call. As you well know, this particular group of traders is focused on taking advantage of a very specific type of option pattern, a conservative type of option pattern, in order to create high probability returns in order to compound that. So, if you are new on this call, that is what we're going to be discussing today. And I do want to welcome you. If this is your first time on this call, we hold them once a month. And I do want to warn you that I don't explain everything about these trades on every call, nor is it possible for me to do so. In fact, as you will hear about, I actually hold these types of calls twice a week for traders who are serious about these types of option pattern opportunities. So I'll discuss that here a little bit more in a second. However, I do also want to warn you that these trades are fantastic. However, you do still need to start small. You need to start small. You need to make sure that you're not reckless in how you put the trades together, and then you need to make sure you follow instructions. Great trades does not mean that you can just throw caution to the wind, and you're going to see some really good trades today as well. So, one of the reasons I say you can start small, and one of the reasons that we trade these option patterns is to create a high probability of success in order to create weekly income. And then what we do is we compound that weekly income. This should be the focus of any trader. It should not be the underlying strategy. In fact, if you are focused on compounding first, that will actually drive you into the direction of the appropriate strategy based on your risk tolerance levels, your abilities, obviously, account size, et cetera, et cetera. But the one thing that it will do is it will make sure that you focus on certain aspects of a strategy that will just simply create a high probability of generating consistent, small, consistent weekly incomes. I realize that's not the sexy way to do it. It's not picking the next Netflix or being able to pick tops and bottoms like everybody touts that they can do, which I honestly don't see very many people that can do it. But nonetheless, by going this route instead of all the other directions that everybody else has you going, if you can get to where you're averaging $100 a week, you're talking about growing a small account by $30,000 in just 6 months. It is very, very important that you get to the consistent weekly income. And if you can continue that average, you can grow a small account into over $3 million in 5 years. Now, if you can't get to $100 a week average, that's probably too aggressive for beginners. But if you can't get to that, that's fine, because even if you only average $50 a week over the next 5 years, you're talking about growing your account into over $1 million. Or if you can only average $20 a week, you're talking about growing your account faster than the most aggressive stock, the biggest growing stock over the last 7 years, which was Netflix. So pay attention to the money management. Now, throughout this call, you're going to see me reference Trade Partner. Trade Partner is my trading platform that I created. It was my brainchild. I created it because I needed it based on my approaches to trading, and I didn't want to stay in front of the market all day in order to make certain simple trades. And so I had Trade Partner created. It's been in the making for 3 years now, and it is a wonderful one. I cannot trade without it now. I'm addicted to it. It's stuck. I'm stuck, and that's where it's at. You're also going to see PDS Trader. And PDS Trader is also a program that I created in order to help me find trading opportunities. And I will give 100% credit to finding the trades that you're going to be seeing today to PDS Trader. If I had not had PDS Trader built, I would have never been able to sift through the mountains and mountains of data uh, with um, with weekly options that have come into existence over the last 4 or 5 years. Not only do we have weekly options now, we have Monday expiration and Wednesday expiration, and it can be very, very intimidating to to take a look at all of that data and try and make any sense out of it whatsoever on a consistent basis. So I fully credit PDS Trader for allowing me to be able to get through the data in such a way that I can find these opportunities. All right, so let's get into the MDOP pattern, the $1 million option pattern. And this is the one that we started with the 98% club, and then it became not available. All right, so this, and when I say it became not available, I mean you couldn't get the price. And that is the key with these trades, is sometimes certain patterns aren't available in certain market conditions because you can't get the proper price. And if you can't get the proper price, that's the determining factor. We don't go and chase an option pattern at a bad price. Right now, or when we started with this club, the pattern was a bearish pattern with a bullish pattern in order to create a very specific type of overall pattern where we have no risk to the downside, limited risk to the upside, but then the market has to go through this profit zone before it ever reaches the risk. That's the principles. That's the principle of this. That's the concept behind this. And quite frankly, it doesn't matter what you use to achieve this, so long as you reproduce the principles. So this became unavailable, and the reason that it became unavailable was because of the pricing. And so right now, I'll give you a look at what's available right now if you were to do that pattern. If we in the past we would be able to put the pattern on for a credit. Well, that has slowly gone by the wayside, and now you're actually putting the entire trade on for a debit of 138, and you can see the credit is absolutely critical with this particular pattern. If you can't get the pattern at a credit, you don't need to take it. And even if you can get the pattern at a credit, as of right now, the market conditions are such that you have to be really careful because the volatility is dropping every pretty much the Monday. We use Friday, Monday option expirations. I'll get to what this pattern is here in a second if this is you're brand new to this call. But we use Friday, Monday expiration combinations, and we're long Monday options. And on Thursday afternoon going into Friday, the volatility in those Monday options drops dramatically. And so sometimes you'll be looking at a profitable trade on Thursday, and then Friday, even though the market hasn't gone anywhere, that profit goes away, and that's all attributed to volatility. And so you have to be careful of that. And I explained that in so many other calls. Nonetheless, let me show you what the normal trade is. And this is back in July when we were doing this consistently, week in and week out. And you'll notice that the bearish pattern here, right? So we combine a bearish pattern with a bullish pattern. So this is the bearish pattern. It's at the time it was a 316, 319. Those were the two shorts, and then we had two longs that expired on Monday, and those were at 320. This is a very specific pattern. It's called the TPO bearish one pattern. And we could get that from a credit of 155. You can see that it's slightly out of the money. And this is why it's bearish neutral, because the market can go down. You're guaranteed to make $155. Market goes up, and you have a break even that's way up here at about 5-6 points above where the market is at. And so it's bearish and it's neutral, but then eventually it does run into some risk. It is absolutely limited in the risk, but there is risk nonetheless. And so what we do is we combine that with a bullish pattern. and we combine it with a bullish pattern so that the cost of the bullish pattern does not exceed the credit brought in on the bearish pattern. And so here's a typical bullish pattern that we're using. You can see a 323, 325, 323 calls for 77 cents each, and that ultimately create. You combine this, you can see that the risk on it is $77, and so we do two of them, and it comes up to a debit of 154. We combine that with my credit of 155, and all of a sudden you have a zero cost basis, right? So you basically have a small credit. However, you'll notice, and that's basically what created this particular pattern. But you'll notice again that as of right now, you can't do that. The pattern structure is the same, but it's mostly underneath the zero line now. And so there's a long, wide area where this is going to lose money. And only in a very small area is it going to make money. And even then, it's not going to be a whole lot. And then if it continues moving up, you have additional risk on that as well. So it's just simply not available. However, what you can do is you can create other things or you can put together other patterns that create a similar type scenario. And this is one of them that we will be looking at today very specifically based on market action right now. And this particular trade, the only caveat is that this one is actually going out a little bit further in time. I like to do these about a week, maybe a week and a half left on them, and that way I'm rotating in, basically every week. Well, this one next week is Thanksgiving here in the States, and the markets will be closed on Thursday. There'll be very low volume on starting Wednesday afternoon and Friday, and so the pricing just is kind of off. You can't really get anything right now for next week. So we're going to go ahead and take a look at the week after. And you can almost always get these 2 weeks out, and there's nothing wrong with doing that, because what I can do is I can put on a pattern right now that's 2 weeks out, and then next week I'll put on another pattern that's 2 weeks out, and then the next week I'll put on another pattern that's 2 weeks out, and I'll be able to create that weekly scenario. And so certainly nothing wrong with going a little further out if that's where you need to start, or even staying a little bit further out, just simply because of the ability to repeat that on a weekly basis. So this is the concept. The concept does not change. The concept is there's no risk to the downside. The risk to the upside is limited, and you'll see the market has to move fairly far to the upside to reach that risk. And then before it gets that risk, it goes through a profit zone. Now, just like the regular MDOP pattern, and I'm going to call this an MDOP pattern as well, but just like the normal MDOP pattern, if it goes up too quickly, you may not have an opportunity to exit at a profit. That's the one major drawback. That's why this isn't 100% guaranteed to make money, and it's because it can move up too fast. And so as you're going through the profit zone, you don't have an opportunity to take a profit, and hence the 98%. So as long as you take a profit as it's going through the profit zone, when it's available, you create odds on this. And so really, the issue here is that if it moves up too fast, it may go into the profit zone, but you don't have a profit. That does not mean that you exit the trade. That's not what it means at all. So whenever you get into these trades, you have to accept the risk associated with the trade. You do not want to panic. Now, if you are going through the profit zone and you have a profit, that's another story. But if you don't have a profit, you do not exit this trade. Period. End of story. Don't do it. you are messing up the probabilities in that situation. The only, and especially if you're a beginner, don't do that. But the only way that I would um, um, suggest that you consider taking exiting the trade as it's moving through this profit zone, but it doesn't have a profit yet, is if you replace the trade that will overcome the loss, put the profit zone further to the upside, and so you create a credit that will equal the loss of the trade that you just exited and just push everything further to the upside. But that's only as you get more experienced with this. And that's the only way I would consider that. Now, we're going to get into the exact details of this trade. However, if you want more of this instead of just once a month updates and once a month call and whatnot, listen, we've made money on these calls. I do these calls twice a week, not once a month. I do these calls twice a week for members of my TPO group. It's called the triple play option. So we deal with option patterns when volatility is low. We deal with option patterns when volatility is high, and we deal with option patterns when volatility is somewhere in between. And right now it's low, and there are some very unique opportunities. I call it my option insanity opportunities, along with these that we've been discussing these for several months now, and we've made money netted basically every week um, that we've been doing it. And so, and sometimes significant gains. So because it moves up into the profit zone right at the end of the trade, and you have the ability to take a small windfall. So if you're not a member of TPO, or even better yet, the all access pass group, where I give you access to everything that I have, my money management course, PDS Trader, Trade Partner, these calls, several other hyper options, C4 options. Those are some great options selling on individual stocks, signals, and programs, and so much more. I would call Spring and ask about that as well. All right, so let's move into this particular variation of an MDOP pattern, or a million dollar option pattern. And this one is, again, the same concept. Market has to move through the profit zone. So what we want to do is we want to create the profit zone. What can create the profit zone? Well, there are several things that can create the profit zone. With the normal MDOP pattern, which is not available right now, we've created the profit zone with a bullish trade. And it was a very bullish trade when you're able to get the price, and when volatility is a little bit higher. And so we did two of these, right? So we're cranking these things up there, and that's the profit zone. That's what creates the profit zone. And then we're basically paying for this profit zone by placing the bearish neutral trade in order to create that. So what else can create profit zones? Well, here's what we've been using. We create the profit zone with calendar spreads now. Calendar spreads are a little bit different than the bullish spread that we've been using with the MDOP. And the reason that we're doing the calendar spreads is because we can still get great prices on the calendar spreads. Whereas the bullish patterns, those are very, very expensive right now. And I could show you something that'll just blow your mind. In fact, I may do that. But nonetheless, um, these are calendar spreads, and so we create the profit zone with calendar spreads. The calendar spreads are generally cheaper, um, and so we can do multiple of them, just like we do the bullish spreads. We can do multiple of them. The only difference with the calendar spreads is that there is eventually risk with the calendars themselves to the upside if the market moves up too far. So that's the only caveat, but it's not too bad because the calendar spreads tend to hold their value if they're in the money. And so rarely will you actually take a loss on a calendar spread if you do it right, if the calendar spread itself moves into the money. But again, it's still limited risk anyway. Nonetheless, we create the profit zone with the calendars, and then what we do is we find a way to pay for those calendars. And how much do we have to pay? Well, on this particular example, I have 4 calendars, and you always know what the strike is because that's the peak of the profit zone. So the strike of the calendars in this is clearly 365, and we already know this because that's where the profit peak is. That's how you can read these graphs. When you learn how these things work, you can look at a graph and you can reverse engineer what the trade is without anyone ever telling you what the trade is. Generally, if you're doing if you're doing Friday, Monday, it'll be really easy to be able to tell what the trade is. And so we can tell what the trade is. We are short 365 calls that expire on Friday and long 365 calls that expire on Monday. All right, so the only question is how many, and if we see what the 365 calls are trading at, and we see what the risk is, we'll know how many are there as well. And I'll go ahead and tell you. Well, I'll get to that here in a second. All right, but the whole point, though, is that with calendar spreads alone, it's not a great strategy because you will lose money if the market stays the same or moves down. Right, so that's not a high probability. Calendar spreads alone actually don't carry the best probabilities. They are often, if you get the right price and they're close enough to the market, there are positive probabilities, mathematical probabilities that can be associated with calendars, but they're not great. I mean, they're just barely over that break-even edge. And so I don't do calendars alone. I do calendars for a specific purpose, and that is to create the profit zone. And then we want to pay for it in order to create the high probability. So we don't want any risk if the market stays the same or moves down as of expiration. Obviously, before expiration, there can be risk, but we don't want any risk as of expiration of this trade if the market stays the same or moves down. Period. End of story. That creates the higher probability because then it has to move through the profit zone before it ever reaches the risk level. And so we find ways to pay for this. And you can use the same exact trade that we used earlier with the MDOP, and that is the bearish neutral trade, something that looks like this. And it's 3 legs, and you have a short one, long 2. And you can create a credit. And if you create a $155 credit, then you would do calendar spreads up here somewhere, and you do multiple calendar spreads, and you can do as many as will fit into that credit, right? You can do it that way, or you can simplify it. There's one way that I like to do it, and that's just simply sell it a way out of the money option and pay for all these things. But that carries more risk, and so with the MDOP, we want to make sure that we keep the risk lower. But again, full disclosure, my best successes with this have been by having bigger risks to the upside. But I will also fully disclose that I have taken some larger losses from time to time doing it that way as well. And so you give some, 6 of one, half a dozen of the other. The key, though, for being able to efficiently compound is to be able to keep the risks lower. Now, I'm not going to get into the weeds because I'm able to use a more aggressive compounding even with the larger risk, but that's because I do some other things. So I don't want to get into that. So the best thing for you is to use a strategy where the risks are low. And so what I want to do is I want to create a way to pay for this, limiting the risk and still creating a credit. And so what I've done here is I've put on a really simple trade, and I'll show you what it is exactly here in a minute. This entire trade. But by creating a way to pay for it, I create no risk to the downside. I have a profit peak and a profit zone here to the upside. And eventually, if the market moves high enough, uh, to around 370-ish, 368, 370, I'm going to start to realize some risk. Now that's 14 points away. And so there are a couple of really good scenarios that can present themselves when you put this thing together. But you create the profit zone with the calendars, you pay for it with some other spread, and that's how you get the blue line with no risk. This is at a credit of 6 cents. You get the blue line, no risk, to the downside or to the upside as of expiration, and then you have limited risk if it moves too far to the upside. And again, you do not want to exit this trade at a loss if the market moves into the profit zone and it's not showing a profit. And that's going to happen if the market moves up too fast. Okay. All right. So let's take a look at what exactly this trade is. And so I want to bring in PDS Trader, and I'm going to move this over to give you a better perspective. And this is it in a nutshell. All right. We have our calendars, which are 365s, is what I told you, 365s. And then we have four of those, and then we have a simple diagonal spread. I did this to keep it as simple as possible. You can do many things, but I'm going to use a diagonal spread to keep it as simple as possible. And so the diagonal spread is a 362 short and a 366 long. Again, this is going 2 weeks out, not next week, because it is Thanksgiving. You can't get these prices. I am in trades next week, but I've already taken profits on some of them, because the market did move down, and the calendar spreads do hold their value. And so I actually made money on my credit, and then I didn't lose very much on the calendars. And so I went ahead and took a profit on some of those. And that happens. And that's one of the good scenarios about this particular approach, is that there are many, many scenarios where you can take profits. You don't have, for example, this is showing a 6 cent credit. If I'm still trading down here a week from now and I show a $40 profit, I'm going to go ahead and take it. If I show a $50 profit, I'm going to go ahead and take it. Because eventually, if the market stays down there, then what's going to happen is I'm going to end up being in a situation where my gain is only going to be like $6 or maybe $10 or $15, which is still fine. If the market tanks and that's what happens, then that's what happens. But I prefer to try and get at least $40 to $50 a week. And if it doesn't look like there's a high probability that I'm going to exceed that at the time that at the time that I have the $40 or $50 profit, if the probability is not very high that I will exceed that, then I'll consider exiting early with that small of a profit. Obviously, if it meanders up, which I think it will do, week going into Thanksgiving is generally bullish. The first week of December is generally bullish. And so I do suspect that the market will move up here. The only thing, though, is that we've got this crazy political crap going on. And either way, the turnout isn't good on this stuff. And so it could put some pressure on the market, and we may not see it go do the normal seasonal thing, but we'll be prepared one way or the other. So with this, there are 4 calendars, and we can fit 4 calendars into the credit that we present. Okay. Now let me show you something really cool, and you can do this, by the way, with one order. That's another cool thing about keeping it simple is you can do it with one order. However, I will tell you that you will it takes longer to get filled at your price if you put it in as one order. So I like to put them in as separate orders because I have a higher probability of getting a little bit better price, but you have to accept the risk of not getting filled on both orders if you do it that way. But you can do this with one order, so it's not difficult to do that. But let's take a look at the calendars. And this is Trade Partner now. So what I've done here with Trade Partner is we have this cool thing. It's called the spread pattern here. You can see the spread pattern right here. Okay. I clicked on spread pattern. It's a pattern spread generator. Told you no one else does this, and it makes it really easy for me to determine what I'm going to put together. So right now, if I go to 12/4, 12/7, you can see the calendar spreads are at about 33 cents, which is a really good price for this to be an in the money calendar spread. That's a really good price. Um, and well, to give you an example, right now, the 355 calendar spreads that expire today, based on the same scenario, are at 80 cents. So and those 350, where are we trading at? We are trading at, maybe I'll see where we're trading at. We are trading, give me a half a second here to open up the right window. We're trading at 357.39. So those are actually in the money by almost 2.5 points, and they're trading at 80 cents. The 357s right now that expire today, which by the way, those they will continue to increase in profit, probably to about $1, maybe $1.10 today. It might max out somewhere around there, but those the 357s are going for $1 right now. So those are at the money, slightly in the money, and they're going for $1 right now. And the 357s that expire today still have $1 of extrinsic value on them. So we're going to see the 357 profit peak probably at about 100 to 110, $120. All right. So these right now are going for 33. The 354s are going for 33. The 355s are going for 33. So what I did is I just basically said, show me all the calendar spreads. And I started at one point and said end at another. And so it's showing me 355 calendar spreads, 356 calendar spreads, 357 calendar spreads, which are 34 cents. And right now those are going for $1. The ones that expire today are going for $1 a piece. So those are very cheap for being at the money. 358, the further we go out of the money, the cheaper they're going to get. 358 is 32, 359 is 32, 360 is 30, 361 is 31. So they're very stable, as you can see. 362 is 30, 363 drop down into the 20s, and so forth until we get to 365. You can see they're at 25. I was actually filled at 24 earlier. So 25-cent calendar spreads. If the market moves up, the spread will get to the spread right now is going for about $1. So that'll be a 75-cent profit per calendar spread. And if you have, for example, 4 calendar spreads, you're looking at a $300 profit at the profit peak. So that is where the profit peak comes from, where the profit zone comes from. And this is, we can start with 365s. We can go up to 366 and get 24 cents, go up to 367, and all of a sudden it's 22 cents. 368s are 19 to 20 cents. 369s are 17 cents. And so you can do whatever. Then the question is, how do you pay for them? And you have to do the same concept and not go near as far out of the money, or you have to have the calendar spreads fairly close the strikes of whatever it is that you're using to pay for them. Okay, so keep that in mind, and let's take a look uh, at the diagonal spreads. Okay, so I did the same thing. I created a pattern on diagonal spread. This is a 365, 369. Okay, 365, 369. And that's going way out of the money. And so I could probably use 370 calendar spreads with this and be just fine. And the 370 calendar spreads are going for like 18, 17 cents. And so I can take a look at this one and I can say 65 cents divided by 17 cents is 3.8. So what I would do is I would say assume 18 cents on the calendars, multiply it by 4, you get to 72. I would put this order in at 72 cent credit or better, and then I would say once that's filled, get my calendars at 18 cents a piece, and that would give me a 0 credit, and that's going way out of the money. The one that we're doing is not that far out of the money. We're doing 365s, 365 calendars, and the calendars are actually lower than the long strike, 366 long strike. Okay, and I can go beyond that if I wanted. I can go 367 calendars, and it'll be just fine. You won't create quite the profit zone, but you'll push that break even level further out. So it depends on whether you want to create a higher probability or a bigger profit zone on how close you put those calendars. Now, what if you can put them so far out that they create what I call a dead zone, and a dead zone is a lag in between profit peaks that can actually lose money. And so you don't want to do that on expiration. So you don't want to do that. You have to be careful of how that is put together. But let's take a look at these credit spreads. So I said, show me every credit spread that's just like this, for starting at 355 going to 370. So here's the 355, 359 diagonal spread, I should say, not a credit spread because it's short 12.4, long 12.7. So 355, 359 going for 209. Guess how many calendars you can pay for? You can go 360s with the calendars if you wanted to do this. You can go 360s with the calendars, pay about 30 cents. So divide 209 by 30 cents, and what do you get? You get almost 7. You can do 7 calendars. The problem is that if the market moves up too fast, too far, too fast, you may go right past the profit zone. And the closer the profit zone is, the higher the probability that's going to happen. Or the farther away expiration is, the higher the probability that's going to happen. But if the market stays the same, you're creating a huge profit zone at around the 360 area by doing it that way. So that's how it works. It's just a matter of how far you want to go out. And so we'll go down here a little further away, 357, 361, so $1.83. So these are quite expensive. By the way, on expiration at 357, this will be worthless. Or actually, this will be a debit. Right now, the 357, 361s that expire today are, well, we're now at 357.50. So those are actually trading at a credit of 65. So you'd be making 100 and something odd dollars on those. And you would add, let's see here, let's say 362 calendars is, so we'll go 362 calendars. You don't see what I'm doing here because I don't want to screw up the screen that it's on, but I'm gonna give you the price of what the entire trade is going for right now, based on the one that expires today. And so 1 second 1 second. That one is at a debit of 20 34 cents. All right. So we're basically at the money. If you get a total credit on the calendars, you'd still be making about $35, and we are on the lower end of the profit zone. And by the way, that will increase as the day goes on. All right, so going on 358, 362, how far out of the money do you want to go? Generally, I say about $1. Whatever, however far I can go out and bring in $1 on this thing. That's basically what I want to do. And so you can see you can get the 362s, 366s for $1. And so that's the first one I would place. And in fact, I will put this one together and place it exactly as I give it here. So 12.4, 1 second, and I'll pull this screen down. 12.4 and 12.7. All right. So I'm going to pull this down, and we're going to place this trade. I'll show you exactly how it's placed. So this one is going for a credit of 62 cents, right? And right now the current one is trading at a debit of 40. So if you got this one exactly the way it is right now, 357, 361 to 362 calendars, you're talking about a 60-cent credit. And that one, if the market goes nowhere, that one right now is trading at about a 40-cent debit. So you're talking about about $100 profit on that one, if that's the one you wanted to do. We're going to go 362, 366. And again, this is just one way of doing these. I obviously don't have time to explain all the different ways. I would strongly suggest that you go to so we're going to do we're going to do 366s instead of 365s. So I would strongly suggest you again call Spring and sign up for the TPO. So what did I say? 366s. All right. So I can do this whole trade for credit of 11-ish. I'm going to put the order in at a credit of 10. Okay. And that way I will give myself a pretty good shot of getting filled all low. So we'll go ahead and do that. Okay, so that one is now been placed, and I'll let you know if that's filled. Oh, yep. Nope, not filled yet. Okay. So let's see here. That's how it works. That's what we've done, and let me pull the questions here. So Q&A. Can you enter and exit a trade with an exit price of SPY reaches the peak price? No, Harry, because we're not going for the peak price. That's not how this works. The peak price is based on the last minute right before expiration, and the probability of that happening is not very high. You will not see the peak price before that. And so we're not going for the peak price. That's not the purpose. We're not doing these to make $500. So you can't expect that. Would this be the best day to buy calendar spreads? Cheaper, I hope. So it's all about the price. It's whenever you can get the price for the calendars. If the price isn't there, you can't get it. I mean, that's literally the dictating factor. Spread generator still in pre-release. Yes, the spread generator is still in pre-release. I expect that to be moved into the current version. It will be a beta, but I expect that to be moved over next week for you guys. Actually wondering why instead of the simple calendars, not to use a slightly a slight diagonal, a short 365, long 365. You can absolutely do that, Mike, sorry. You can absolutely do that, but the deal with the 365, 366s at 3 cents a piece, you are creating a $100 risk per piece. All right. So you have to be careful with that. I've done that before. And you also have to realize that when you do that, you're not going to see those increase in price very soon. Right? It takes longer for a diagonal spread to actually show um, um, the profit at that point. So I would shy away from it just simply because of those two things. If the market goes up fast, you ever roll up with more lots, martingale, to get more lots on the higher probability. So obviously, if you have a small account, you can't do that. If you have a larger account and you understand what you're doing, you understand the risks, yes, you absolutely can do that. Yes, I absolutely do that. But if you do that, you can also plan for that by buying more calendars further up at a much cheaper price um, before the market ever moves up. That gets a little bit into the weeds. I don't want to get into that in this call. If you're a member of the TPO, ask that question again, and we'll actually go into that in some detail. All right, perfect. So I would always look at anything that you're considering doing. I would take a look at the possibility and what that price is a week from now and what that price is on the day of expiration and go from there. Okay. All right. Any other questions? Okay. Looks like I got all the questions. That will be it for today. I will see you guys next month. And if you're not in the TPO, get involved in the TPO. Strongly encourage you to do that. All right. Harold, I would contact support on that, and they should be able to point you in the right direction. All right, everyone, have a wonderful day and weekend.